Yeah, and when we listen to those job numbers and everything, Scott, I think that there's a lot of telling things there. And we start looking at, well, how is the Fed going to react? Things look awfully strong. A lot of thoughts about the job creation that was out there, or at least those that were getting jobs, or those numbers weren't even close, especially when you look at the revised numbers going back to December as well. Not even close, 510,000. I mean, the numbers are showing us that there is strength there. People are returning, whether it's vaccines and boosters and whatever, people feeling much more comfortable getting back in the workforce, hourly wages going up. I think all of that says to us that in a lot of people's interpretation, we're going to see the Fed start to make some of the action, maybe a little bit more action than we even anticipated just not too terribly long ago. So I think that there's a lot to this move. And you look at volatility and where we are right now and these moves that we're getting each and every day, Scott, a lot of it catalyst driven, of course, with earnings and so forth. But it's just it's a wild ride right now within the markets, because are you wanting to focus more on crude? Are you looking at inflation? Are you looking at jobs? What are you looking at? And each and every day, of course, we have to go through that. And that's why we are in the markets. That's why we're seeing this kind of volatility, this kind of velocity, this kind of volumes and participation that we're seeing in the markets right now.
It's so funny, you know, after the report came out, the first bit of commentary was, oh, my gosh, the Fed's may have to do 50 basis points. That was back in the conversation. Steve Leisman's been doing a lot of work underneath the surface to try and make better sense of the jobs report. And as he points out, just before we came on the air via Twitter, the household survey was much weaker than the headline number would suggest. Maybe that is why the NASDAQ, for example, has turned positive, and the market is not certainly as bad as it looked right off the open today, given the jobs report and then the Fed being once again in focus. Shannon, I want to read you something that Dan Niles said in the last hour on CNBC. I thought it was pretty interesting. Quote, I hate to mention the word recession, but when you've got oil going up this much, the economy is slowing, multiples are compressing, and the Fed is not your friend, cash is a position. I wonder what you think about that in the context of where you're advising people to be within the market today.
Cash is still a really difficult place to be, Scott. If we look at expectations for equities this year, we're still looking at, a high single-digit number with cash earning you essentially nothing. And it's going to take some time before cash can earn you a position. Now, if you're a more active trader and you're using it, obviously, from an institutional capacity to fund purchases and some of these pullbacks that we've seen, because we certainly could get another couple of pullbacks this year similar to one that we had to experience in January. But I think the other part of this is that, Dan is setting up a scenario which is, not necessarily completely out of touch. But we're not looking at the stagflationary environment that people were so fearful of 6 or 8 weeks ago. And I think this employment number shows that. But I also wouldn't put too much emphasis on this particular print for jobs. We've had significant revisions. Steve talked about it on Twitter, as you mentioned. And, there's been a lot of erratic reporting as it relates to households and employment over the last year and a half. So, again, I'm looking forward. I know the Fed's going to be data dependent. I think rushing to assume that we're getting a sharp deceleration in economic data and that the Fed is going to be significantly more aggressive because of one particular monthly non-farm payrolls print is probably overstating the situation.